John.
So hard to believe it's middle of the year already, and we've come through a lot, even just in the last 6 months. But thinking about the last 15 or so, it's really been a fascinating period. So the everyone's starting to come out with their projections for mid-year and where we go from here. So I just want to run through the IMF and the Congressional Budget Office and their latest projections and what the takeaways are from that. So, so the IMF is showing actuals for 19 and 20, and then projections from 21 to 26. And they're doing real GDP, unemployment, Fed funds, the 10-year government bond, core PC, and the deficits or surpluses. And we're deeply in deficits now. So just wanted to go through this kind of quickly and highlight some of the IMF takeaways from what's going on. So looking at real GDP of 7% this year, which is a very healthy rebound from last year, just under 5 for next year, but only averaging between 1.9 and 1.7% from 23 to 26. So after we get through the initial bouts of stimulus and everything else, we get back to the real issues, which is we have subpar growth throughout the world. And we really need to get our productivity up, and we need to get our population growth back on track to get better GDP growth. So those two themes continue to be keys. You can see the unemployment dropping from 6.8% in 20 down to 4.4, and then working its way down into the threes on average for the 23 to 26 period. Fed funds not moving much, 30 basis points next year, 50 basis points the year after that, and then 50 basis points the next 2 years. And then the 10-year kind of struggling to get above 3% as you look forward. And that's in large part due to the fact that we have subpar inflation expectations going out, even after all the stimulus that's gone on. And look at the deficits running, the levels that we're at are actually the highest we've had since 1946 for last year and this year. So, but then starting to decline pretty steadily, but still a pretty healthy number on GDP. So, we have some nice opportunities, but then we revert back to pretty stagnant growth, full employment levels, and not much on the rate side or the inflation side going forward, and deficits that are running out for pretty much as far as the eye can see. The CBO, Congressional Budget Office, also came out with their report, and they looked out through 2031, I'm sorry. And you can see the dark blue is the July projections, the light blue is the February projections. And, clearly the growth is running hotter than people were expecting. And I think there's a couple reasons for that. When we look at the CBO or the IMF, and I think with the IMF, it's really they are all in on the policies that have been put in place, both on the monetary and fiscal side. They think in the IMF's case, on the fiscal side, we're actually in a transition period on monetary policy, but fiscal policy really needs to kick in right now and carry the ball. And I think in DC, it's the same view with the CBO, but healthy growth throughout. Deficits, the worst that they're projected to be for this year and last year and this year, and then getting better and then progressively worse as we get further out. And a lot of the 26 through 31 period is the roll-off of the Trump, the sunsetting of some of the provisions of the Trump tax cuts, which is going to increase the deficit. So we cannot run deficits, at these levels if we want to be a successful economy. And just to put it in perspective, the 50-year average of the deficit to GDP is about 3.3%. We're projecting, as I just showed you, before from the IMF, they're projecting over 4.5% out in 26. So we're running well above what the deficits have been since World War II. So when you look at the debt held by the public, that's still going to continue to rise and is still jumping up even from February projections here from the Fed. So that's not exactly a great setup. And look at the net interest cost projections change as you go into the out years. Clearly, that's a reflection of people being concerned about inflation running a little bit hotter than it has been, pushing up interest rates and the net interest costs for the U.S. But those jumps are not insignificant, even just from the out in 31, you're adding $100 billion or more just to the net interest costs. So a real challenge and kind of mixed numbers, but how did we get here? Well, I think the IMF, the couple things you have to know is the IMF projections factor in the full Biden tax and spend plan. So the tax would be about 3.6 trillion. The spend would be 4.4. The CBO projections do not factor into that. They only take in what is law on the books. You're going to see strong growth from both really into the out years, but it does start to decline, and that's when the debt and deficits start to rise. But really, it comes down to how much do we grow and what our net interest costs are going to look like as we get out into the out years. Monetary and fiscal support is being reduced, but we have a very healthy handoff to consumers, satisfying their pent-up demand and in corporations investing in productivity. But we're going to have very volatile numbers that reflect some of the short-term distortions that are in the markets. And we think that's going to be a challenge. So I think you're getting good policies being put in place from a monetary perspective. From the fiscal side, we really need to see what is the Biden administration going to be able to get through with their own party and with the Republican Party as we go through. And how does the handoff work its way through? And we'd be remiss if we weren't really talking about what a great job our healthcare system has done in getting the vaccination rates up. But that creates another problem in that we've had such good success getting people vaccinated that the vaccination rates are slowing. And does that create a bigger problem on the longer term outlook for not only the US, but for the rest of the world in creating bigger problems on the reopening? So I guess the mid-year outlook is positive, but still cautious with a lot of volatility in the numbers that we're going to see. I think the health opportunities continue to be quite strong for the nation, and the economic opportunities are going to be quite good, but we really have to get our act together in DC if we're going to continue to lead and lead appropriately and manage our way out of this and still meet the big issues that we have to face, whether it's the inequality issues, the other issues that are all in the headlines right now, but also just getting people back to work. And how do we do it in a prudent way is, still under a lot of pressure. And it's actually going to be one of the interesting things to see as we get through a 4th of July. Does Washington work the way it was originally designed to work? And it looks like for all the fits and starts that we're having as a nation, it still is one of the places that you'd want to live over many other places because of what a great nation we have. So I'll leave it at that and open up to questions, Mark.
That's great. Well, actually, I was reflecting on my July 4th fireworks with my daughter when you said, what a great nation. For all our warts. But what do people think? Questions on what Stephen just shared with us? Oh, Zale?
Stephen, you're so negative. It sounds like everything we're spending too much money and it's just going to go down. Why don't you believe that we're going to spend so much money and the economy is just going to be booming and booming and booming with this infrastructure and everything else, and great jobs? It's just going to do, that whole, I mean, I'm not an economist, so I only took Echo 101 and 40 years ago, but I spend money, you spend money, I spend money on a supplier and it just expands everything.
I'm not if I came off negative, I just think we have challenges that require real solutions, and we got to get the real solutions put out. And what I'm negative on is the politicizing of everything without, in my view, a proper end game for how we're going to move the country forward. And we're being too divisive. So from that side, I'm negative. Economically, I'm actually pretty positive. The US over most of the rest of the world, it's really the US and China, with Europe coming on pretty strong now, in large part because they've gotten past a lot of the austerity and have moved to spending. But at some point, the bill comes due. And that's what I'm concerned about, is when the bill comes due, or for all the spending, are we going to have higher productivity and a better economy as a result? Or are we just going to throw away a lot of money? And I'm generally as positive on the US as a nation dealing with its problems as anybody, but when it comes to DC, I'm not in that camp. That's why I want to lead us out of this. I'm much more favorable on consumers consuming the way they're supposed to, and businesses making smart investments, than I am on the government leading us out of it.
Yeah. Other questions, comments?
What are other people's outlooks, Mark, is what I'm curious about.
Yeah. Well, yeah, I am too. Mark Halsum, I haven't seen you in a while, or Sherry Lee, or Sael, Tom. Just curious what you guys are seeing, or questions you might have on all this.
I have a question for Stephen. I really want his opinion on it.
Shoot.
Okay, so I was reading on Reuters that the guys who are leading $6 trillion of assets, I posted it on 361, this article, that they want to raise the value of carbon. They want to, according to Reuters, they want to triple the value of the carbon tax and want it consistent around the world. And it was like, whoa, this is like they're talking like Biden, and they're $6 trillion worth of assets. They're all pension funds and those sort of folks. And I was wondering if you saw that and you had any comment on that.
I didn't see it, so I don't have a comment on it.
Stephen doesn't check our app as much as he could. It's okay.
Too busy trying to get the weekly presentations done.
I know, which is great. What are other people saying? Because Susan, I see you on screen. Are you optimistic? And if not, why? And if so, why? You're on mute.
Well, I'm certainly quite optimistic about the UK because we're about to be released on the 19th of July in full. And because now 85% of the population has had its first vaccination, and over 65%, close to 70%, being fully vaccinated. So the numbers are really very compelling compared to the rest of Europe. And we're in a stronger position than the rest of Europe. What's interesting to me is to see that that sterling is weakening against the dollar. And I can't tell whether that's because of the long weekend, because I do a lot of FX trading actually. So that's rather unfortunate. So I'm waiting to see whether certainly what you're saying, Stephen, is reflected in the currency. And we're seeing that across the board. But it feels like everyone here is ready to spend and ready to move. And there's a real impetus in the UK to get back to some level of normality. Otherwise, these vaccinations have been an utter waste of time. Incidentally, this COVID has really taken Africa by the neck in the last 6 weeks in a way that hit Europe 5 months ago. And South Africa in particular has been suffering pretty badly, but treating itself with ivermectin, which is used for sheep. It's basically a It's a veterinary medicine, and it's being used by people very actively in Zimbabwe, in South Africa, and in Mozambique to treat, as a prophylactic, actually, to treat, in fact, in advance of getting COVID. So this ivermectin treatment has really taken hold in the South as well, alongside the fact that no one can get a vaccination. And very few people can be vaccinated. I think sort of like 2 or 3% of the population in some of these countries is vaccinated.
Well, it's a segue of, you want to just tell us what you're going to cover on the 13th?
Yeah, I'm quite excited, actually. We have some really compelling speakers. In fact, they're all very good. So a really exciting format. And we're going to go from the big picture, the macro picture, with Adrian Saville, who is a notoriously fine speaker from the University of Pretoria Business School and speaks very widely, to looking at Africa, which again now, and Luke sent a really interesting piece around about the investment in Africa from various countries and what the picture looks like now compared to 1996 till now. It's largely a Chinese-owned Africa, and now I think Kenya is trying to renegotiate its debt with China, by the way, right now for $7 billion, and China is not having any of it, and this debt is due at the end of this year. So I'll be interested to see what happens on that score. But
How is the World Bank and IMF functioning on that front?
I don't know. The IMF is not, to be honest, you don't read a lot about, I don't read a lot. I read a lot about Africa, but I don't see a lot of evidence of the IMF extending to Africa right now. They're not as obvious as they were, say, 10 years ago. It's all about Chinese loans. And this latest with Kenya is very similar to Zambia, Zambia is owned by China. And frankly, Kenya's in a pretty deep soup as well. So, and that's, there's good and bad, but the good is that these countries are developing and they have a better infrastructure and they have some investment, but the downside is that that China really is permeating Africa through and through, and everyone else is asleep. But anyway, on the speaking front, I really like the agenda. I think that we're kind of cantering through not just the macro and not just China, but business regulations and other topics that we think would be really interesting to the audience. And a bit of philanthropy and development capital with CDC, which is the UK development agency here. It's nothing to do with the American CDC. And then the panel at the end, which is covering tech and infrastructure and women, gender lens investment, and 3 or 4 or 5 groups that are completely different in media. So that will be interesting because media and leveraging Cape Town and other really good venues for filmmaking now is big, and making films and advertisements, etc., in Africa is big. It's big business. So across the board, I think quite a diverse agenda and a week today.
So I'm looking forward. And I think your video is going to be circulated and everything. We played it earlier.
Okay.
Morning. Just on your point on inclusion, so that everyone knows, as we kick off our Midwest tour, maybe you could join this panel. It's right after Jack's wife has a fireside on her book, the first woman in corporate America. But it's we offer golf and cocktails. And,
that sounds like too good to be true.
No, it's true. It's going to happen.
That sounds great.
You do 2 10-minute interviews with a student.
Brilliant. Brilliant.
And as other people may have seen, this is all come together in this document here. So we'll share it. We're within a day or two of finalizing, and so you can book your flights and hotels. Although it's actually quite inexpensive to get around the Midwest, as you'll see.
Mm-hmm. Yeah, I've spoken out there before in Ohio. Ohio is a big green belt, isn't it? So I've been out there a few times.
So other questions on what Susan covered, Midwest or otherwise?
I guess, hey, Mark, I had a question about Zale's comment. I just wanted to, I guess, I didn't read the article, Zale, but I'm just curious, do you think carbon should not be, more valuable? Do you think carbon should, I'm just curious to hear your perspective, because deep down, I feel like, carbon is a really important asset, or at least, kind of something that we as a society need to be thinking about. And I think placing value on it is probably one of the only ways that companies or, organizations will really begin to focus and actually find a way to measure, and whether it's a cap and trade system or have some kind of system in place. But so I'm curious to hear your thoughts as to why that article was egregious, or it sounds like that was at least your take on it. So I'm just curious to hear your thoughts.
Oh, okay. So I thought the article was amazing. I think putting a price on carbon is absolutely amazing, because what the goal and again, go to 361 to see the article. What they're saying is, by putting a price on carbon and raising it, it's going to drive up the value of alternative fuels. So, for example, if you're paying a huge amount for carbon, then all of a sudden, electricity generated by wind becomes much cheaper and much more valuable. I happen to be a big proponent of electricity from nuclear, because I think it's a very, very good technology, even though I'm of the age of Chernobyl and 3 Mile Island. But the purpose of what these pension funds are doing is, by driving, the summary of the articles is, they're driving up the price of carbon, forces other technologies to become much more valuable. So don't think it's a grievous at all. I was very excited, and I kind of wanted to make sure that Stephen was on board with it, because I think Stephen's amazing, and I want him to be next president.
Gotcha. Thank you.
Yikes.
Carbon
You have
would
my
be a
vote as
very-
well, Stephen.
Carbon would be I don't know whether we've ever done a deep dive on carbon and carbon trading, but it is such a big business, and it's going to be monumental over the next decade, I think.